bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the September 12th, 2023 podcast. We at Novogradac are very focused on helping our clients access federal tax credits to raise investor equity, to build, renovate, and or preserve a variety of affordable housing and community development properties and businesses. While such properties and businesses often rely on federal tax credits to raise the bulk of the much-needed investor equity, often a financing gap remains. This is where state tax credits often come to the rescue. State tax credits are often the crucial tool to filling financing gaps for high-impact community development investments. This statement is no more true than in the arena of state historic tax credits. 38 states have some version of a state-level historic tax credit, a credit that's paired with the federal tax credit. And my column in this month's Novogradac Journal of Tax Credits documents the vital role state historic tax credits play in making many historic preservation redevelopments financially viable. In my column, I also document how state historic tax credits catalyze greater levels of activity as compared to states without a state-level tax credit. I turn to National Park Service state-level data on the amount of historic preservation activity to demonstrate how state-level historic credits encourage more renovations. The National Park Service data on historic renovation activity is quite clear. States with state-level historic tax credits have more historic rehabilitation development than states without a state-level credit. Now, I will provide the link to the column in today's show notes so you can review it on your own. I also want to share some particularly good news. It does appear that state legislatures across the country are recognizing this impact. There's been a considerable number of bills introduced and enacted this year to create or expand state-level historic tax credits, as well as state-level low-income housing tax credits and new markets tax credits or their approximate equivalents. They agreed more about these trends and what we can learn from state historic tax credits in my column. But today, we're going to look at state historic tax credits from a slightly different vantage point. Today, we're going to discuss what you need to know if you're a developer or an investor and you're seeking to preserve an historic building and contemplating accessing state historic tax credit equity to reach financial feasibility. And not surprisingly, there are some differences between the federal historic tax credit and various state-level tax credits. There's also things that you need to consider if you're going to try to access a state historic tax credit. Those are the topics we're going to discuss today. For the novice listener, let me briefly explain how historic tax credits work. The federal historic tax credit is equal to 20% of the qualified rehabilitation expenditures, which are essentially the cost the taxpayer incurs in rehabilitating a historic property. This credit is claimed over 5 years. Now, there are other requirements that you need to meet in order to qualify for the federal historic tax credit. One simple example is that the property has to satisfy a substantially rehabilitated test. Another is that the building needs to be listed on the National Register of Historic Places or be located in an historic district and be significant to that district. State historic tax credits often are similar to the federal credit, albeit they do have notable differences. For example, the tax credit percentage can vary greatly. In some states, the credit is as low as 5% of qualified rehabilitation expenditures, and in others, it can be as high as 30%. With some states also providing bonus percentages for properties that meet certain additional criteria. Before introducing my guest today, let me share with you that Novogradac is hosting our annual Historic Tax Credit Conference next month in Charlotte, North Carolina. The actual dates of the conference are October 12th and 13th. Many of the topics we'll be talking about today will be covered at the conference, and just as importantly, the conference provides an opportunity to network with others in historic preservation. I'll provide a link to the conference in today's show notes. And if you make it to the conference, please take a moment to introduce yourself to me. I'll also note that the current plan is for the Historic Tax Credit Coalition to also have a meeting in Charlotte, contemporaneous with our conference. Now, let me introduce you to our guest today. Joining me is my partner, Warren Sebra. Warren works out of Novogradac's Portland, Oregon office. Warren works with quite a number of developers of historic properties. He assists them in accessing federal and state historic tax credits. Warren provides a variety of consulting, forecasting, audit, tax, and other professional consulting services to such clients. Warren also works with clients in the affordable housing and other community development fields. And of note for this podcast, Warren recently wrote a blog post that takes a deeper dive into the data about state historic tax credits and the amount of rehabilitation done in those states. I will include a link to that blog post in today's show notes. In today's podcast, Warren and I will talk about what developers need to know if they're considering working with state historic tax credits, which, as I noted earlier, will include a discussion of the differences between state credits and the federal historic tax credit. After that, we'll also talk about what developers should consider if they're working in a state that doesn't have an historic tax credit. So that's a lot to talk about, as you can hear. So if you're ready, let's get started. Warren, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's great to be here again.
It's great to have you back. So I wanted to start with a somewhat basic question, the question that I'm sure you get from many developer clients. So assume I'm a developer and I'm trying to raise or considering raising investor equity for state historic tax credits. And obviously I'm raising this equity to help fund the renovation of a historic building. What are some of the first things I need to know? What are some of the first steps I should be taking?
Yeah, it's an excellent question. I think if you are contemplating having a historic tax credit project, you're probably going to find, hey, there's going to be a gap of financing. And to kind of use the state historic tax credit as a gap filler in those states that have that can be a very useful tool. But every state is different. Every state does things differently in terms of if they have one, and even if they have the state historic, it could be different. Some states have project caps. Some states have annual caps. States can have multiple rounds of applications and different ways to apply. And some states may have limits on how much each developer can use. So certain developer itself may have a cap. So those kind of the first things to know is like each state is different. They don't necessarily mirror the federal credit in terms of the percentage of credit, what's allowed, and how the credit is calculated. Sometimes it's going to be different from state to state. So those are kind of the main thing you need to know is just, hey, it's different than the federal, and you have to kind of do a little bit of research to figure out how to apply in that state. And some examples, for example, that there is between states is Massachusetts, has an annual cap, but no project cap. And North Carolina has a project cap, but no annual cap. And they may have a certain percentage different for mill projects. Kentucky, for example, another example of why it's different, they have an increase in a percentage if you have any residential rental properties for a historic tax credit project. And so it's good to know the details, because if you don't know the details before you get into it, you might not be able to have the right information as you're working out your financing. And a federal investor might not be the same investor as your state investor. And so why so? They're coming into federal, why don't they take the state? Oftentimes your traditional historic tax investor might not have tax liability in a state the project is. And so you have to seek out the state tax credit investor, and it can be hard to find, especially in a smaller state, to find an entity that has a lot of tax and is willing to invest. And so oftentimes you have to find a good consultant that go find that investor for state credits. So those are some of the things that are different and could pose a little bit of challenges in using the state historic tax credit. But if you find it, it's a really useful tool to help fill that gap. And Mike, as you remember, I was on a podcast with you in March about filling financial gaps in historic tax credit deals. And we've talked about the state tax credit and other tax credit incentives that could help fill that gap.
Great. Thank you for that, Warren. And thanks for pointing out your prior podcast appearance. I do remember it. That was a great topic about filling financial gaps in historic tax credit properties. And there was also a podcast episode in January about the different structures, different types of structures for historic tax credit transactions, which often is critical and can lead to a difference between federal and state credits, can have different impacts under those structures. And even going back to last year, we had a podcast about comparing term sheets for historic tax credit properties, or from different term sheets for different investors for a given historic tax credit property. And for our listeners, I'll just let you know that I will provide links in today's show notes to those prior episodes, as well as some other podcasts that we had that covered the historic tax credit. But let's turn now to some of the notable differences between the state and federal historic tax credit. I mentioned in the intro that the tax credit percentage is often different, the state credit percentage than the federal percentage, which is 20%. But there are other notable differences. So maybe you could take a moment now, Warren, and maybe discuss some of the differences, the notable differences between the federal historic tax credit and the various state historic tax credits that are out there.
Yeah, good. I think one of the differences that I would like to point out is when the equity comes in. The historic tax credit investor will often give between 15 and 25% of the equity at closing, and the remainder during certain benchmarks after construction. With state historic equity generally comes at the end of construction. State tax investors are unwilling to kind of take construction risk, and if you're relying upon that to fund their construction, you have to bridge the equity, because generally that state equity will not come to after construction. So that's one key element is, hey, your equity come after construction. You can't rely upon it as a construction source. And your state investor is generally not heavily involved in the closing of the transaction. Your federal investor will be heavily involved. And if your federal investor happens to be the state in some circumstances, then the state investor is involved. But generally, your state investor is not a big player. Hence, that's kind of the reason why that it comes afterwards, after construction is done. And one of the things, is oftentimes your state credit price, it will be lower than your federal price. And you're wondering, why so? Credits are credits. Sometimes it comes down to basic economics, meaning that there's less demand for state credits. And so that less demand is going to drive down the credit price. Oftentimes you have the terms of state tax credits we talk about is, are they certificated or allocated? And allocated credits and certificated credits, I'll talk about more detail in a little bit, but allocated credits tend to be significantly less in credits than certificated credits. And so when you're looking at state programs, more beneficial programs to fill in gaps and provide increased equity is going to be your certificated credits.
Those are great points. Thanks for sharing them. I would just add, in terms of the state equity coming in later, state tax credit equity coming in a touch later, as you pointed out, the state tax credit equity investors aren't often super involved in closing, things of that nature. To a certain extent, a state credit investor oftentimes is relying on the federal investor for a lot of the due diligence and other items, which is one of the reasons why they come in a tad bit later, because they can see the transaction proving itself out as opposed to the earlier phases during development. And also note, when you talked about the state credits transacting at lower cents per dollar pricing, since you're saying lower price, what do we mean? It's cents per dollar, and cents per dollar is not the same depending on when you get the timing of the cash flows and all the rest. But I would just note to our listeners that if a corporation is the investor, if they actually pay state taxes, those state taxes are deductible against their federal income tax liability, or against their taxable income, such that it reduces the federal income tax liability. So a state tax credit, in a sense, is taxable. So the lack of a deduction, the inverse of that is making it taxable, albeit they do get a benefit when they exit the transaction. But that taxability aspect does have an influence on equity pricing. But I'm not going to go into the weeds there. I'm going to give you a chance to not go into the weeds on another topic. Just going to cover the surface. And I would just say, for listeners, you should reach out to Warren if you have any more specific questions, or you want to get into the weeds, which obviously, if you're developing a property and you're marketing these credits, you definitely need to get into the weeds, or hire someone to get into the weeds, and hire someone to get into the weeds with you. You mentioned certificated and allocated state tax credits. So if you could explain to listeners what a certificated credit is versus what an allocated state tax credit is.
Yes. Thanks, Mike. And like I said, not to get into too much deep doctrine of tax here, there are some principles that are important to understand about certificate and allocated credits. And like Mike said, if you want to go into more detail, please contact me. I'm happy to walk through some really finer details of certificate and allocated credits. But it's also kind of on the surface to kind of know what they are. If you have an allocated credit, that means a state credit investor is actually going to be a partner in the partnership. Certificate of credit, the state tax beneficiary is not going to be. And those certificated credits are basically a sale of credits to an outside party. And that sale can causes taxable income to the partnership who's selling those credits. And so there's some structuring issues there that to be aware of who has the allocated income. That's very important to kind of figure that out at the onset if you're doing certificated credits. Allocated credits, it's not going to be taxable in terms of the tax credits, but the allocated credits, because certain situations are going to be less valuable to the partnership, meaning that cents per dollar is going to be less than certificated credits. Certificated credits will produce more cents per dollar in terms of investor equity than allocated credits. And that's a very common question. People say, hey, does, Arkansas have a state tax credit? Well, is it certificated or allocated? That's always the very first thing you want to ask and figure that out before you go into it, because it make a big difference in terms of cents per dollar in terms of the equity from an investor.
Yeah, thank you for that discussion. And I can't help myself here. I want to get into the weeds a bit. So you can pull me out if I get sort of too deep here. But when I think about state tax credits, I always think about the fact that the federal credit, as a general rule, isn't property and isn't separately transferable. Now, when I say that, there are going to be listeners going, wait a second, Mike, you had a podcast not that long ago talking about transferable renewable energy credits. And obviously with the Inflation Reduction Act last year, the concept of transferring federal tax credit was created for a number of renewable energy tax credits. But beyond that, federal tax credits generally aren't property in this sense. It's something that flows, but is it generally considered property? State tax credits, on the other hand, are considered property that the partnership generates. And when you think of certificated credits, you get a certificate that gives you the right to claim the credit. So basically the partnership ends up with this certificate, this piece of paper, this intangible property right that it can then sell, much like it can sell property. And as a consequence, that property, when it's sold, has no basis and generates income to the partnership. And when you think of allocated credit, I always think of it as the partnership has this certificate or this right to claim these credits. It's not a certificate, it's not separately transferable, but the partnership has this economic benefit and it allocates it among its partners. So it ends up showing up on a K-1. And as those of you that have listened to prior podcasts, we even talk about the fact that it's property, it's considered a distribution of property, and that can create tax issues as well. That once again, I'm not going to go into a deep dive here, but those are critical differences. And as you pointed out, Warren, they greatly affect the value of those credits. And as a property partnership, you need to be focused on the net value after taxes to the partnership. And there's a variety of structures to deal with certificate credits or allocated credits. And maybe we'll have a podcast sometime in the future just on certificated versus allocated credits, the pros and cons.
And the structures, right?
Exactly. And the various structures, but that won't be today. So we have talked now about, accessing state historic tax credits, and, we've discussed it almost as if every state has one. As I noted in the introduction, that not all states have one. And my column in the Journal of Tax Credits notes how those that have a state historic tax credit do generate a lot more historic renovation activity in their state, and highly correlated to the amount of state credits. But there are 12 states that don't have a state historic credit. And there are a number of states that have a historic tax credit, but you end up with a very low credit percentage or an annual cap that's low enough to where, you can't access it to close your financial gaps. What do you recommend to someone looking at an historic property in one of those states?
I can tell you listeners, hey, I live in one of those states, right? Oregon does not have a state historic tax credit. So I can tell you deals do get done. It's actually really interesting to look the states that have state historic tax credits. It's heavily concentrated, east of the Mississippi, and less concentrated in the west of Mississippi. So why so? there's different theories, but generally there's more older buildings, in the Eastern United States and less older buildings in the Western United States. But it is really interesting to see a map that's heavily concentrated on the East Coast, in east of Mississippi, and not in the West of Mississippi. So there's definitely East Coast bias, just like in sports, right, Mike? Anyways, but deals do get done in these states that don't have a state tax. So it can be done. Oftentimes you have to find other ways to fill your gaps, right? It could be increased sponsor equity, other soft financing available through a state and local economic initiatives. There's housing. There could be some state and local grants or soft finance you can find. And obviously, we deal with a lot with new markets and local housing tax credits. When those deals are combined together, it can help increase your financing gap. And so that's one of those kind of gap fillers that you have to kind of figure it out if you don't have it. They do get done. It's not like those states that don't have state historic tax credit incentives that don't have projects done. And so you can get it done. It just takes a little more effort on your side to fill those gaps. And Mike, you mentioned your report or your Washington Wire article, and it was really interesting to look and say, well, one of the states east of Mississippi that doesn't have it is Tennessee. And I'm not picking on the state of Tennessee. It's just back to the matter. They don't have it. And, if different podcasts will say, Mike, what are the states that border Tennessee? And there's 8 states that border Tennessee. If we were doing some trivia, I'd ask you, but we're not doing that here.
Well, I wrote the column and I noted 8 states, so I'm going to have an answer to that one.
You would have an answer to that one. That's good. But there's 8 states. And it's kind of, I'm from the West, and generally you don't have 2 or 3 states, but Tennessee has 8 states. And all those 8 states that border Tennessee do have a state historic tax credit. And Tennessee has a very robust historic tax credit. Properties have been done over the years. The National Park Systems keeps track of these things, and they have quite a significant of properties that have been used as historic tax credits. But if you look at the states outside of Tennessee, they have received more applications for the Part 1, Part 2, Part 3 applications, and all these states have that. So it's interesting to look at that correlation, that there was more properties done, more projects done in terms of the applications that was applied to the National Park System. And so I thought that was really interesting in your article to read about that. I'm like, oh, okay. Hope the other states can see that and see how there could be more investments, more economic opportunities going forward if you have a state historic tax credit in your state.
So thanks for pointing that out. And I'd say were a tad modest, because I think that if someone's looking about ways to fill gaps in a state that doesn't have a state historic tax credit, they can also listen to the podcast.
That's true.
Just on that topic. But I'd also just say, thinking longer term, you should be working with your state to have a state historic tax credit enacted. And if you take a look at the column in the Journal of Tax Credits, it provides a pretty good example of the math behind the additional benefits generated by having this gap filler to make more historic preservation developments feasible in your state. And obviously the additional generation of economic activity helps generate more tax revenues for the state. So there's lots of arguments that the actual cost of the credit is there isn't a net cost, because the additional economic activity. We're all leave that to formal economists to debate. So I appreciate you sharing all this information with our listeners today, Warren. And I'll just mention to our listeners that if you're considering a historic rehabilitation, or if you're in the middle of one, I do encourage you to reach out to Warren. There's a lot of services he can provide to you to help you maximize the amount of equity you generate, as well as to avoid any traps for the unwary. But before I actually wrap up, Warren, I wanted to see if there's anything else you wanted to share with our listeners.
Yeah, thanks, Mike. And I always appreciate being on the podcast. Just want to remind everyone that we are going to have our annual Historic Tax Credit Conference, October 12th and 13th in Charlotte, North Carolina. Charlotte, North Carolina does have a state historic tax credit program, a very robust one. It's been around for a long time. And then, just a reminder of Mike's column about state historic tax credits, my blog that kind of talked a little bit about the state historic tax credits. We also have handbooks and booklets on historic tax credits and help enhance your understanding. So feel free to reach out to me or go to our website to how to attend the conference or to find our blogs or Journal of Tax Credits and the handbooks.
Thank you for that. And thanks for also the reminder of the Novogradac Historic Tax Credit Handbook, as well as the introduction to the Historic Tax Credit booklet. So please check those out on our website or email Warren or me. So thanks again, Warren. The links to the booklet handbook will be in today's show notes. And do stick around, Warren, for the off mic segment, which I ask you some fun off topic questions. That'll give you the opportunity to share some words of wisdom for me and our listeners. And to our listeners, be sure to tune in next week when we celebrate the 800th episode of Tax Credit Tuesday. Pretty hard for me to believe that we've reached 800 episodes. That spans a lot of years. And we're going to celebrate the 800th episode with a special podcast. I'm going to have my partner, Tony Grapponi, joining me. Tony is based in Novogradac's Andover, Massachusetts office. And Tony and I are going to discuss renewable energy tax structuring trends. This is particularly urgent or important at this time because with the Inflation Reduction Act enacted last year and IRS guidance now getting to the point to where there's a lot of transaction structuring that's actually being implemented. We've spent a lot of the last year dealing with questions and the rest. And now we're seeing the actual development starting. And we really expect that to be picking up substantially over the next 12 months. Tony and I are going to touch on various hot topics with respect to IRS guidance and deal structures. And we're going to talk about some of the ways in which production tax credit versus investment tax credit considerations affect deal structures. We'll talk about how transferability of energy credits are impacting the inverted lease structure. We'll also talk about varying views on transferring renewable energy tax credits as opposed to the traditional tax equity structuring, particularly keeping those in mind as we head into the fourth quarter of 2023. So those are just some of the main topics we're going to touch upon. And we can even touch upon a question that you have. If you have a question, please send an email to cpa@novogradac.com. And if it comes to me in time, I'll include that question when I have Tony on as guest. So please tune in next week to our 800th episode. So now we're going to turn to our off mic section, where I get to ask guests off-topic questions. They can provide some words of wisdom to me and to our listeners. This is the third time you've been on the podcast, Warren, as we noted. And surprisingly, I realized I haven't asked you one of my favorite questions.
All right.
So I'm going to do it today.
Okay.
You have a busy schedule, as do I, and I'm always interested in time management tips. So if you could share with me a time management tip that you found helpful.
Yeah, thanks, Mike. I think every professional probably is always trying to find ways to increase their productivity and having great time management. It's something that I think I struggle with a little bit, but there's a few things that I've done last couple of years to be better at it. One thing I've done, it's kind of hard to explain, but I'll just in a little detail, is on your Windows desktop, through Display Fusion, you can create different desktops. So the idea is, hey, if you have multiple things going on, you can put them on different desktops and not be distracted by having them open. Because some people say, well, just close everything out and have one thing open. Well, when you have to open up things up, it takes time. So you have multiple desktops hidden behind each other. You work on one project, you only see one project. And then when we're done, we have to switch back to something else because something pops up, you can go to the different desktops. So that's helped me not take time opening and closing things, but also keeping projects separate from the other time to avoid the chaos and distractions that could happen. You're trying to accomplish something pretty quick. Oh.
Is that with multiple, do you have multiple screens?
Well, I have two screens, and then for the Display Fusion, you can create within those two screens, multiple desktops.
Got it.
I'm not a tech nerd, so set it up for me. By all means, I don't know how to do it, get it set up, but it can be done, and it helps me to not be so chaotic in my workflow.
I'm going to give it a try.
Okay.
So thank you for that tip. Another question that I'm constantly asking guests, which I'm also surprised I've not asked you before, and it has to do with the coming conference season. We at Novogradac have a number of conferences coming up on affordable housing tax credits, historic tax credits, market tax credits, renewable energy tax credits, opportunity zones. And that it means I'll be traveling a lot. So if you could share a travel tip or two with our listeners that you found helpful.
Yeah. It's not so much helpful. I think it's more of a state of mind that I have.
That's helpful.
Well, true, but
The
it's not
most
like
helpful.
it's not some kind of hack you might find on the internet. Like I think myself, as I've gotten older, I've tried to do two things when I travel. As one is try to see something cultural or something about the area you're going, whether it's visiting a quick museum, seeing a statue, walking over a bridge, doing something that's unique to the city you're going to. And sometimes it's hard. Travel skills is busy, but I always try to spend a little bit of time doing something non-work related but cultural in that city. And to add upon that, if I have time, I try to get lost, meaning that I'd be purposefully lost. Like say a dinner plan didn't go through and I'm going to dinner by myself. I just wander the city and try to get lost and see what happens, see where I end up. And so I say, try to get purposefully lost. And it kind of enhances your experience. And when you get back from your trip, it always seems if I do these things, I'm less worn down. I feel more energized to do my routine when I get back. So those two things that I try to do.
So really love those tips because I can definitely find myself sometimes, driving to the airport, parking, getting into this aluminum tube, flying to a country, to a different city, getting in an Uber, going to the hotel, speaking, doing all the hotel sort of activities, getting back in an Uber.
You're like, where did I even go?
Aluminum tube, coming
Right.
back. So, and then realizing that, did you even know what city you were in?
Right.
And I can vouch for Warren practicing what he preaches because we were in, I believe it was in DC.
Yeah, we were.
On the street.
Yeah.
And where were you headed?
It's some random dinner place because my dinner plans failed. And I said, I'm just going to go find a place. So just wandered around and see where it took me. Actually turned out to be a really fun night.
Yes, yes. So thank you for those tips, Warren.
Yep.
To our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.